Hi, I'm Patu from freefincal, and today let's talk about why you should not expect returns from your gold investments and what you should do instead. Every time the stock market is turbulent or there's some kind of fear that sets in, gold price typically tends to move up, and then people ask, shall I buy some gold or shall I have some exposure to gold in my portfolio? It's a wrong time to ask that question, but that's how many people operate. So, to keep things simple, there are three distinct ways in which one can use gold, and out of those, only two are legitimate or logical, I should say. The first is, you say that, look, I want to accumulate some gold for my children, whether a girl child, boy child, doesn't matter. You want to do that. So because of sovereign gold bonds, you can now do this in a tax-free, risk-free way. I mean, you can buy a sovereign gold bond, hold it for 8 years. Let's say you need gold after 10 years. You buy the next tranche of sovereign gold bonds, hold it for 8 years, and then after 8 years, in the last 2 years, you just keep it in cash or you buy the jewels whenever possible. That's all. You are tracking the price of gold. The gains are completely tax-free if you hold it until maturity, and there's no risk because you're tracking the price of 24 karat gold, and anyway you're going to buy 22 karat jewels. Because wastage etc. will take care of all the difference in quality, will take care of all that. So that's the simplest way to do it. The only catch is that you have to put in a lot of money to buy those bonds. You have to put a lump sum now and buy the bonds. That's the only catch. You must have that money. Otherwise, if you don't want to buy sovereign gold bonds because you don't have that money, you want to do it, accumulate gradually, then don't buy those bonds every month. That can be a pretty big nightmare. Although technically it's possible, the government may issue it every month. In the secondary market, you may or may not be able to get it because other people have to sell it at a loss, then only you will get it. So don't depend on the secondary market, but in the primary market, you may be able to get it, but sometimes the government may issue, sometimes they may not. A simpler way is what Ashal Jowhari suggests, that you start a liquid fund or an arbitrage fund, do an SIP. Every month, your SIP amount should be equal to you invest a month, an amount equal to what the current 1 gram price of gold. That's enough. That is also same as tracking the gold investment. Of course, there will be a difference in taxes and so on. That's life. You cannot control everything. That's the first approach. The second approach is to say that, look, I have a portfolio, I want to reduce risk in my portfolio, I want to add an asset class that behaves differently to stocks and fixed income. Hopefully when stocks go down, this asset class will go up. Then you include gold as a third asset class. You diversify. You have, let's say, 15-20% of gold. Then you diversify regularly. You rebalance regularly. Monitor the variation in risk, monitor the returns, and that's one way. It's a legitimate way to handle to track gold. Sovereign gold bonds will not help for this. You need a more liquid instrument where you can sell and buy freely. Gold ETFs are ideal because they are the low cost. They are the lowest in cost other than sovereign bonds. But they may not be liquid. So a gold fund that invests in a liquid ETF where the price to NAV is not too different would be a very good option in my opinion, because the AMC will take care of the buying and selling risk. You don't have that, and that's a better option in my opinion. So those are the two legitimate ways. The third approach is what most people do. Like, when you take a dog for a walk, first it will go and sniff on this side of the road, then it will go and sniff on that side of the road, here, there, and so on. People invest like that. That is the third way of buying gold. People invest after it has moved up, they will say, let me buy gold. So that's not really a right thing to do. So let's leave that. So to explain why you should not expect returns from gold, we will now look at some charts. The first chart that you're going to see is the normalized movement of the US price, that is gold US dollars, that is per troy ounce. 1 troy ounce is about 31 grams. Then you have the black one is the gold movement in INR, the green is gold movement in USD, and the blue line is the exchange rate. You can see how After the huge spike in inflation in the late 70s, the gold price started falling down for almost 2 decades in the US. But during this time, because our economy opened up and our exchange rate picked up, you can see how the forex had kept moving until about 2000. The gold in INR kept moving while gold in USD kept falling down. After that, the forex movement was kind of the gold price caught up with it, and then the US and Indian gold price more or less kept in tandem with each other. And another popular misconception is that because the exchange rate always goes up, the gold price in INR will always give you more returns than the gold price in USD. That is wrong. You can see here the 5-year rolling returns of gold in USD, which is brown, and gold INR, which is yellow. You can see that that's not true. There are some times when the returns are similar, sometimes when the returns are different, and so on. And you can see that almost 6,000 points there for 5 years, and it fluctuates all the way from 20 to 23% to minus 8%, 10% for INR, and minus 20% for gold USD. It just fluctuates too much. The spread in the returns are simply too high for you to expect anything. Over 10 years, you can see the same situation. The spread in the returns is too high. Again, returns can be comparable. Over 15 years, again, the spread is too high. Now the INR has made a difference, but then that's in the past. In the future, it will not be the case, because much of this past takes into account the economy opening up and so on. Over 20 years, also you can see the variation in returns is simply too high for us to expect any kind of return. Over 25 years also, it is still too high. You just can't expect, because something or the other is happening. The US had their recession in the late 80s. We had the Harshad Mehta scams, stock market opening up, dot-com crisis, 2008 recession. Something or the other will come now, coronavirus. Something or the other will come and cause this volatility. So you just can't expect any kind of returns. Some people say the returns will be in par with inflation. This is the gold 10-year rolling returns for USD, and this is the 10-year inflation in consumer price index, and you can see the inflation has kept going down, whereas the price has been fluctuating, and then it moves up. So you can see when the inflation is going down, the returns have gone up, and then it has come down. There's really no correlation because the market forces are just too much. Too many forces are pulling and pushing these things. You just cannot say anything, expect anything, and so on from gold. So use gold. So use sovereign bonds if your ultimate aim is to buy golds. I have made a video on this. I just want to do it again. If your ultimate aim is to buy jewelry or consume gold, then use sovereign gold bonds. If your aim is to diversify, manage portfolio risk, manage portfolio return with a particular target corpus in mind, then you don't need to worry about returns. You can use a gold fund to add a little gold. Of course, a multi-asset fund will work, but then it has to be the single fund or the major component in your portfolio to make a difference. That would not be the case for most people. So that's what I wanted to say in this video. Thank you. Bye-bye.